Hello and welcome to the latest in our Insider interview video series. Today I'm joined by James Dow, who is fund manager of the Baillie Gifford Responsible Global Equity Income Fund. James, thanks for your time today.
Thank you for inviting me.
So James, the fund invests in sustainable growth stocks that are also resilient dividend payers. Could you talk us through the key attributes and characteristics that you like to see in a business?
Sure. Well, we're quite picky about what we own. We want our clients to own really fantastic companies. So we've got a pretty long list of qualities and attributes that we look for, but let me give you a few of them. A big one for sure is we want every company to have a really strong, attractive growth opportunity, to be able to grow its sales and profits for at least the next 10 years. So if you look, for example, at our largest holding in the fund, which is Novo Nordisk, a pharmaceutical company, they're a leader in making insulin for diabetes and appetite suppressants for people controlling their weight. And our view is there's a huge growth opportunity, really attractive growth opportunity in sales and profits for the company as more people are diagnosed with diabetes and also with the appetite suppressants. So growth is a really big part of it. Another key one for us is a really great business model with attractive financial characteristics. So companies that are doing something that's really valuable for their customers and that's really hard for other people to do. So if you think of Novo Nordisk again, it's definitely really valuable for the customers. It's often a life-saving or life-changing treatment, and it's very hard for other people to do, and that means they have attractive profits, attractive returns on capital. Third one would be very cash generative businesses. So businesses that not only can invest for future growth, but they have loads of cash left over at the end, which they can then pay back to shareholders as dividends. And that gives them an enhanced return, an even higher return if they're also getting those dividends. Final one I would always pick out would be responsible long-term management of the company, because our experience is even if you find a company that has that great growth, great business model, cash generative, if it's not run by really good people who have a long-term mindset, and so in Novo Nordisk's case, you've actually got a charitable foundation taking a long-term view about the science and innovation and so forth. Without that, it probably won't come to pass. So those are some of the characteristics that we're always looking for to find these really great companies.
You've just touched on sustainability. Could you talk us through how you apply environmental, social and governance factors into how you invest?
Yep, so the foundation of that for us is a process that we call IAT. IAT stands for Impact, Ambition, Trust. So that's a process, a proprietary process that we use for everything that we invest in. We put it through that process. So what we ask with any company we look at is, first of all, its impact. What is its impact on the environment, on society, on wider stakeholders? Is it a heavy emitter of carbon? Is it having social impacts that we need to think about? Data privacy, something like that. So we evaluate that first and give it a score and how well it's doing. We're then looking for ambition because no company is perfect. There's always room for improvement, and we want to own companies where the people running them are ambitious to keep getting better. So even if they've got low emissions, well, how do we get to zero? Have you got a science-based target? We want to see that ambition in them as well. The last part is the trust part, because, particularly these days, pretty much every company says, oh, absolutely, we're going to do the right thing and we take ESG very seriously. But we also know that, unfortunately, not all of them can be trusted to deliver on that. So a big part of our evaluation, again, is do we trust these people to actually deliver on their commitments, and why is that? So that's the bedrock of our analysis, and we're looking for companies that score really highly on all of those factors to go in. It's very company specific, as you can imagine. It's not just like a tick box exercise. It's very long-term oriented because of the nature of what we're doing, but that's the foundational piece of research for us.
Every asset manager, particularly nowadays, talks about engagement. So how do you engage with companies? How do you set yourself apart from competitors?
I'd say the really big differentiator stems from our long-term investment horizon. So our average holding period is 8 years, is typical investment for us. Many that go beyond that. And what that means is we have a different relationship with the companies we invest in when it comes to engagement, because, these issues are often long term. They're quite tricky about getting to net zero or whatever it involves. They often have a a short-term cost for a long-term benefit. The difference for our engagement, I think, is that companies know from our record that we're going to be there on that journey for the long term. We're not just there for a quick buck to get a vote and then sell the shares. We're going to be with them on that journey. So an example I like to point to holding the fund is Albemarle, which is the world's biggest producer of lithium. And several years ago, we said to them, in our engagement, we'd really like to see you undertaking independent audits of all of your operations to make sure they're as clean and efficient as they can be. It's costly, but we think it'll be a good thing to do, good for your business. And they knew that it was quite a large shareholder, that when we asked for that and engaged for that, it was not like we're going to sell the shares next week. Many years later, they've implemented that. They're getting the benefits of that. We're still shareholders. So I'd say that alignment on time horizon is probably the biggest differentiator for when we engage with our holdings.
So this particular fund, it was launched nearly 5 years ago. Could you name a couple of examples of stocks that you've held since launch that tick the boxes for you of delivering sustainable growth and have resilient dividends?
Yep, so Novo Nordisk would be one that I mentioned. That's been a really strong performer for us. I think sort of 300% increase since we first invested. TSMC, a semiconductor company that sort of pretty well known, has been a great performer for us. Albemarle, I just mentioned. There's quite a number of them. And not only have these delivered really great profit growth and share price appreciation, but they've, as you mentioned, they had those resilient dividends as well. And a key sort of proof point of that is that those names I mentioned in 2020, when obviously the world economy is having a lot of problems with COVID, all of those names actually increased their dividends in 2020. So I always say, well, that's an amazing testament to just how resilient these businesses are, that they were able to even increase dividends back in 2020. So those would be some examples.
A smaller part of the portfolio is in more opportunistic stocks. So these are companies that, will hopefully for the funds grow quicker than the market, but the dividend yields may be below the average market yields.
Yes.
Could you talk us through this bit of the portfolio and name a couple of stock examples?
Absolutely, and by the way, we're big believers in the benefits of investing right down the yield spectrum. A classic example being years ago when we invested in Apple, and it was a point such and such percent yield, below 1%. But if you look at the capital growth and the income it's now delivering, it's like over a 4% yield on our book cost now. It's been a fantastic investment. So definitely we're keen to do that. A couple of examples today would be Cognex. So that's a leader in machine vision equipment. So you'd probably be aware that lots of companies at the moment are saying, how can I automate what I'm doing, particularly in production, maybe it's in logistics or whatever. The secret of that is not just a little camera that can see what's going on in the factory, but very clever software on the back end that can understand what's going on in the real world and send the right signals and deal with that. And Cognex is a world leader in both the vision and the software. Huge growth opportunity, committed to a resilient dividend, cash generative business model, run for the long term. So all those things I talked about earlier, responsibly managed. Today, the dividend yield is less than 1%, but our view is on that 10-year horizon, given the fantastic growth, given where the dividend's likely to grow, likely to be a great investment for our clients. So that would be one. Intuit, the tax and financial services company, would be another example, again, below 1% yield, but think about the next 10 years, the capital return you could get from that, the income growth ticks all of our boxes, responsibly managed. So those would be a couple of names.
You compare your performance against peers. So those funds that sit in the Investment Association Global Equity Income sector.
Yep.
So since launch, how would you say the fund has fared?
It's been pleasing. It's been good. And over that period, of course, we're quite growth oriented, and growth has come a bit out of favour. Despite that, over 3 years, the fund is second quartile within its peer group, and we're on track over 5 years. I say on track because the 5th anniversary is just coming up. We're on track to be first quartile over 5 years when we get there. So despite that growth headwind. So we're pretty confident that the values that we're espousing around responsible long-term management, great growth opportunities, we are actually seeing it work and deliver great results for clients.
Yourself and your team manage a number of other funds and an investment trust. So how does this responsible fund set itself apart from those other funds? I noticed that there's a lot in common in terms of the top 10 holdings with the Baillie Gifford Income Growth Fund. I think there's 9 of the top 10 are shared in common. So how is the responsible fund different?
Yes, that's right. They're very, very similar, very heavy overlap. There's one key difference between them, and it really comes down to how do our clients think about ESG? And the best way to illustrate that is with a stock example. So that's Coca-Cola, which is owned in our Global Income Growth Fund, but not in our Responsible Fund. So if you look at Coca-Cola, you'd say amazing business model, lots of opportunities for growth. It's going into other types of beverages, really strong, very cash generative, run for the long term. But we also know that it produces a lot of packaging, which has an environmental impact, and a lot of its products have high sugar levels in them. Now, when we talk to our clients, there's typically 2 attitudes that clients will take to that. Some clients will say, if you engage with Coca-Cola and you genuinely believe they're on a journey to reduce their packaging and recyclability, reduce sugar levels and so forth, I'm happy for you to invest in that. And that would be why it's in the Global Income Growth Fund. But we've got another section of our clients who say, no, until Coca-Cola has been on that journey and substantially reduced its packaging and sugar levels, I don't want it in my portfolio, I want it out. And we do not own it in the Responsible Fund. Now, we respect both of those approaches to ESG. They both make complete sense. But the question we ask clients is, well, which one are you? So if you're the type of client who says, I don't want that in my fund until they've improved, then the Responsible Global Equity Income Fund is the one for you.
And in terms of your sustainable process, does this lead you to exclude certain stocks or sectors?
Yes, we do have several exclusions. So fossil fuels will be one example as excluded, tobacco, gambling, a range of sectors like that. So, no BP, no Shell, no, for income funds is a little bit unusual, none of those sectors. And then we also exclude anything where our judgment is they may be contravening the UN Global Compact principles. So for example, we look at supply chains to look at potential labor abuses that might be happening in those, and anything that we're concerned about, that would also be excluded. And I think the key point I'd make with exclusions, some clients ask or they wonder about, is this going to harm my financial returns by excluding these things? What impact does it have financially? And our view is, well, it's possibly quite good for your returns, because if you think back to what I said earlier about the long-term growth and the attractions of that over 10 years, and you think about, let's say, a business of hydrocarbons, oil and gas, it's pretty hard to believe that's going to be a great growth business over the next decade when you're pumping out oil and gas. So our view is we have these exclusions, and probably they're likely to actually enhance your financial returns, give you better returns to stay away from some of these troubled businesses over the long term.
Thank you for your time today.
Pleasure. Thank you for inviting me.
That's it for this episode of Insider Interview series. You can check out the rest of our interviews on our YouTube channel, where you can like and subscribe. Hopefully, see you again.